You don't control your money. This does most people grow up believing a simple idea. If you earn money, it is yours, and you fully control what happens to it. You work for it, you save it, you spend it, and you assume every decision is entirely in your hands. But modern financial systems are built in a way that quietly challenges this belief. While you do control how you use your money on a daily level, you do not control the deeper system that determines its value, availability, and movement across the economy. Money today does not exist as a completely independent asset sitting outside the system. It exists inside a network of institutions, rules, and digital infrastructures that constantly influence how much money exists, how easily it can be accessed, and what it is worth at any given time. Central banks, commercial banks, now and digital financial platforms all interact in ways that shape your financial reality long before you make any personal decision. This means that even though you physically hold money or see numbers in your account, those numbers are part of a larger system that can expand, contract, or revalue itself based on policies and decisions far removed from individual control. Understanding this structure is not about conspiracy or abstraction. It is about recognizing how modern monetary systems actually function in practice. To understand what it truly means when people say, "You don't control your money," we need to break down how money is created, managed, and influenced at every level of the financial system. What "you don't control your money" really means. When people hear the phrase, "you don't control your money," it does not mean that you cannot spend or save it. Instead, it refers to the fact that the value, supply, and behavior of money are controlled by systems outside of individual influence. You may decide how to use money, but you do not decide how much money exists in the economy or how powerful each unit of money is over time. The value of money is constantly being shaped by inflation, interest rates, lending conditions, and central bank policies. These forces operate at a national or global level, meaning your personal financial decisions exist inside a framework you did not design and cannot directly change. Even if you never borrow, invest, or participate in financial markets, now your money is still affected by these system-wide adjustments. This creates a separation between personal control and systemic control. On a personal level, money feels direct and tangible. On a systemic level, it is fluid and constantly being redefined. The same amount of money can represent different levels of purchasing power depending on decisions made in banking systems and monetary policy meetings. In this sense, money behaves less like a fixed possession and more like a shared resource whose properties are adjusted by institutions. You interact with it, but you do not determine its underlying rules. Understanding this distinction is the first step in recognizing how deeply financial systems influence everyday economic life. The role of central banks in money supply. Central banks sit at the center of modern monetary systems, are acting as the primary authority responsible for managing the supply and stability of money within an economy. They do not typically interact with individuals directly, but their decisions affect every transaction, price, and financial opportunity in the system. One of their main roles is controlling how much money exists in circulation. They do this not by physically distributing cash, but by influencing the conditions under which money is created in the banking system. Through policy decisions, they can encourage or restrict lending activity, which directly impacts how much new money enters the economy. When central banks aim to stimulate economic activity, they make borrowing easier by increasing liquidity and lowering barriers for banks to issue credit. This leads to more money entering circulation as loans expand. When they want to slow inflation or reduce economic overheating, they tighten conditions, making borrowing more expensive and reducing the flow of new money. Another important function is maintaining stability in the financial system. Central banks act as a backstop during crises, providing liquidity to prevent collapse and stabilize markets. While this helps prevent economic breakdowns, it also reinforces their central role in determining how money behaves under stress. The key point is that central banks do not simply observe the economy. They actively shape the environment in which money exists. Their policies influence inflation, employment, borrowing, and even long-term wealth distribution, making them one of the most powerful financial institutions in modern society. Commercial banks and the creation of credit. Commercial banks play a much larger role in money creation than most people realize. While central banks set the rules, it is commercial banks that carry out the majority of money creation through the lending process. Every time a bank issues a loan, it does not simply hand out existing money. It creates new money in the form of credit. This process means that money supply expands whenever loans are issued. When someone takes a mortgage, starts a business loan, or uses credit for large purchases, new money is effectively introduced into the economy. That money did not exist before the loan was created, and it enters circulation through spending and deposits. This system ties money creation directly to debt. The majority of modern money exists because someone, somewhere, is in debt. This creates a financial structure where expansion of credit drives expansion of money supply, and contraction of credit can reduce it. Commercial banks also influence who receives money first. Since loans are given based on creditworthiness, income, and collateral, those with stronger financial positions often gain access to larger amounts of newly created money. This creates an uneven distribution of financial opportunity right at the point of money creation. In this way, commercial banks act as both gateways and filters. They determine how much credit enters the system and who gets access to it first, making them essential participants in shaping the flow of money throughout the economy. How digital banking limits financial autonomy. The rise of digital banking has made financial systems faster, more efficient, and more accessible, but it has also increased the level of structural control within the system. Nearly all modern money exists in digital form, meaning access, movement, and storage of money are entirely dependent on banking infrastructure. Every transaction, transfer, or payment passes through centralized digital systems that are governed by financial institutions. This creates a situation where access to money is no longer purely physical or independent, but dependent on permission-based systems that can impose rules, limits, or restrictions when necessary. Digital banking also increases transparency for institutions. Every financial movement leaves a traceable record, allowing banks and regulators to monitor activity at scale. While this improves security and reduces fraud, it also means financial behavior exists within a fully observable system. Another key impact is the removal of physical alternatives. As cash usage declines in many economies, individuals become more dependent on digital access to their funds. This increases reliance on banking platforms for even basic financial activity, making uninterrupted access to systems essential for everyday life. In effect, digital banking does not remove financial autonomy, but it centralizes the infrastructure through which money must flow. This means personal financial control exists within a system that is highly structured, monitored, and dependent on institutional access. Interest rates as a control mechanism. Interest rates are one of the most powerful tools used to influence economic behavior and control money flow within the financial system. At a basic level, interest rates determine the cost of borrowing and the reward for saving, but their impact extends far beyond individual financial decisions. When interest rates are low, borrowing becomes cheaper, encouraging individuals, businesses, and governments to take on more debt. This increases spending, investment, and overall economic activity, which in turn expands the money supply through increased lending. Low rates often lead to higher asset prices as investors seek returns in markets rather than savings accounts. When interest rates rise, borrowing becomes more expensive, which discourages debt accumulation. This slows down economic activity and reduces the pace at which new money enters the system. Higher rates can also increase the attractiveness of saving, shifting money away from risk assets and into safer financial instruments. Because nearly every major financial decision is influenced by borrowing costs, interest rates indirectly shape housing markets, stock markets, business expansion, and consumer behavior. Even individuals who do not actively borrow are still affected through changes in prices, wages, and investment returns. In this way, interest rates function as a central control lever within the financial system, influencing not just money flow, but the entire structure of economic activity. Inflation as an invisible control tool. Inflation is often described in simple terms as rising prices. But in reality, it is a much deeper mechanism that reshapes how money behaves across an entire economy. It does not act like a single visible policy decision. Instead, it works slowly in the background, adjusting the purchasing power of money without requiring any direct action from individuals. This is what makes it powerful. It changes outcomes without changing how people feel they are making choices. At its core, inflation reduces the value of money over time when the supply of money grows faster than the supply of goods and services. This means that even if your account balance stays the same, what that money can actually buy gradually decreases. The system does not need to take money from you directly. It simply makes each unit of money worth slightly less than before. Inflation also influences behavior in subtle ways. When people expect prices to rise in the future, they are more likely to spend now rather than later. This increases economic activity and encourages circulation of money within the system. At the same time, it discourages long-term holding of cash, pushing individuals toward investment, debt, or consumption instead of saving. Over long periods, inflation becomes more than just a price adjustment. It becomes a structural force that shapes financial planning, wage expectations, and investment decisions. It quietly defines how people think about money, time, and value. How governments influence personal spending power. Governments influence personal spending power not only through taxation and wages, but through broader economic policies that shape the environment in which money is earned and spent. While individuals decide how to use their income, the actual value of that income is heavily affected by government decisions that operate at a macroeconomic level. One of the most direct influences comes through fiscal policy. When governments increase spending, they inject money into the economy through infrastructure projects, subsidies, salaries, and public services. This increases demand within the economy, which can raise prices and shift purchasing power across different groups. Taxation also plays a major role. Taxes reduce disposable income directly, but they also influence behavior by encouraging or discouraging certain financial decisions. Changes in tax rates can shift investment flows, savings patterns, and consumption habits, indirectly shaping how individuals allocate their money. Governments also influence wages through labor laws, minimum wage policies, and employment regulations. These policies affect how much people earn, but not always how much they can actually buy. If prices rise faster than wages, see real purchasing power declines even if nominal income increases. In this way, personal spending power is not only a result of individual income, but a reflection of broader policy decisions that determine how money flows through the economy. Currency restrictions and capital controls. Currency restrictions and capital controls are mechanisms used by governments and financial authorities to regulate how money moves across borders or between financial systems. While they are often introduced for stability, they also represent a direct form of control over financial freedom at the systemic level. Capital controls can limit how much money individuals or businesses are allowed to move internationally. This can include restrictions on foreign investments, limits on currency conversion, or requirements for approval before large transfers. These measures are often used to prevent financial instability, protect national currency value, or manage economic crises. Currency restrictions can also affect access to foreign exchange markets. In some systems, individuals may face limits on how much foreign currency they can purchase, or at what rate they can convert their money. This creates a separation between domestic financial systems and global financial participation. While these controls are typically designed to stabilize economies, they also highlight an important reality. Access to money is not always fully free or global. In certain conditions, movement of wealth can be regulated, slowed, or restricted based on policy decisions rather than individual choice. This means that financial autonomy is not absolute. It exists within boundaries defined by national and international financial regulations. The debt system and dependence on borrowing. Modern economies are deeply structured around debt, making borrowing not just a financial option, but a core component of how money circulates. Most money in the system exists because it was created through loans, meaning debt is directly tied to money supply itself. When individuals, businesses, or governments borrow money, they are effectively participating in the creation of new money. This system allows economies to expand, invest, and grow. But it also creates long-term dependence on continuous borrowing to maintain economic stability. Over time, this leads to a cycle where new debt is often required to manage existing debt. Governments refinance obligations, businesses roll over loans, stock and households use credit to manage expenses or acquire assets. This creates a system where financial activity is continuously linked to borrowing behavior. Because of this structure, interest rates and credit availability become extremely important. When borrowing is easy, economic activity expands. When borrowing becomes expensive or restricted, economic growth slows, and financial pressure increases across the system. In this environment, debt is not just a personal financial tool. It becomes a foundational layer of how money itself is created and sustained. Why savings lose value? Over time, savings lose value over time primarily because of inflation and the way modern money supply expands. When more money is introduced into the economy without a matching increase in goods and services, each unit of currency becomes less powerful in terms of purchasing ability. This means that money stored in cash or low-return savings accounts gradually loses real value even if the numerical balance remains unchanged. Over time, what once represented significant purchasing power can become insufficient to cover the same goods, services, or assets. This effect encourages behavioral change across entire populations. Instead of holding money in savings for long periods, individuals are pushed toward investment, spending, or asset ownership in order to preserve value. This shifts financial behavior from preservation to participation in financial markets. It also creates a structural disadvantage for those who rely heavily on savings, such as retirees or low-risk earners. Without returns that exceed inflation, their real wealth slowly declines even without active spending. In this way, the erosion of savings is not just a personal financial challenge. It is a systemic outcome of how modern monetary systems are designed to function over time. The illusion of financial freedom in modern systems. Financial freedom is often described as the ability to earn, save, and spend money without restriction. On the surface, modern economies appear to offer exactly that. People can open bank accounts, use digital wallets, invest in markets, and transfer money across borders with relative ease. This creates the impression that money is fully under individual control and that financial decisions are purely personal choices. However, this sense of freedom exists within a system that is heavily structured by institutions, regulations, and infrastructure. And while individuals can decide how to use their money, they cannot operate outside the rules that define how money functions. Every transaction passes through systems that are governed by banks, payment processors, and regulatory frameworks. This creates a gap between perceived freedom and actual financial structure. People feel autonomous because they can choose between options, but the range of those options is defined by systems they do not control. Even the ability to hold, move, or store money depends on access to platforms that are centrally managed. In this way, financial freedom is not absolute freedom from the system, but freedom within a system that sets the boundaries of what is possible. Payment networks and transaction gatekeepers. Every digital transaction today passes through a network of intermediaries that act as gatekeepers of financial movement. These include banks, card networks, payment processors, and settlement systems that verify, approve, and record transactions before they are completed. When a payment is made, it does not move instantly from one person to another. Instead, it is routed through multiple layers of verification and authorization. Each layer ensures compliance with regulations, fraud prevention rules, and financial policies that govern how money can be used. These systems are essential for security and stability, but they also mean that access to money is mediated. Transactions can be delayed, flagged, restricted, or denied based on criteria set by institutions rather than individuals. This introduces a level of oversight into everyday financial activity that most users do not actively see. Payment networks also determine which types of transactions are allowed and under what conditions. This means that financial access is not only about having money, but also about being permitted to move it through approved channels. In this structure, gatekeepers are not just facilitators of money flow, they are also regulators of how that flow occurs. How policies shape what you can buy or do. Financial policies influence not only how money is earned or stored, but also what it can be used for. Governments and regulatory bodies can implement rules that restrict or encourage certain types of spending, effectively shaping consumption behavior at a systemic level. These policies can include restrictions on certain goods, to limits on financial transactions, or compliance requirements for specific industries. While many of these rules are designed for safety, taxation, or economic stability, they also influence the practical choices available to individuals. In some cases, access to financial services is tied to identity verification, credit history, or regulatory compliance. This means that the ability to purchase certain assets or services may depend not only on having money, but also on meeting institutional requirements. Over time, this creates a structured environment where financial behavior is guided by policy frameworks. Individuals may believe they are making independent choices, but those choices exist within boundaries defined by regulation and system design. And this shows that money is not just a medium of exchange. It is also a controlled access system that determines what economic participation looks like in practice. The shift toward cashless economies. The global economy is steadily moving toward cashless systems, where physical currency plays a decreasing role in everyday transactions. Digital payments, mobile banking, and online financial platforms are becoming the dominant methods of exchange in many parts of the world. This shift increases efficiency, reduces transaction costs, and improves traceability within the financial system. However, it also increases dependence on digital infrastructure for access to money. Without digital systems, most financial activity becomes difficult or impossible to perform. In a cashless system, every transaction is recorded and processed through centralized networks. This creates a fully digital financial environment where money exists primarily as data, rather than physical objects. While this improves convenience, it also means that access to money is entirely dependent on system availability and permission structures. The reduction of cash also changes the balance between anonymity and transparency in financial activity. While this can reduce fraud and improve regulation, it also increases the level of visibility into personal financial behavior. As cashless systems expand, money becomes less of a physical possession and more of a networked resource managed through institutional systems. Ways individuals can regain financial control. Regaining financial control in modern systems does not mean escaping the system entirely, but rather understanding how it operates and positioning oneself strategically within it. Financial control begins with awareness of how money is created, moved, and influenced by external forces. One approach is diversification of financial exposure. This means not relying on a single form of value storage, such as cash alone, but understanding how different asset classes respond to inflation, interest rates, and economic cycles. Assets that preserve value over time can help reduce exposure to currency devaluation. Another important aspect is reducing dependency on debt where possible. Since modern money is closely tied to credit systems, managing borrowing carefully can help reduce vulnerability to interest rate changes and financial tightening cycles. Financial literacy also plays a major role. Understanding how banking systems, not inflation, and monetary policy work allows individuals to make more informed decisions about saving, investing, and spending. Knowledge does not remove systemic influence, but it improves positioning within it. Finally, maintaining flexibility is key. Economic systems change over time, and those who adapt to new financial structures are better able to maintain stability. This includes staying aware of technological changes, policy shifts, and new financial tools that emerge within the system. True financial control in this sense is not about isolation from the system, but about understanding its rules deeply enough to navigate it effectively. Modern money does not operate as a simple tool that individuals fully control. It functions inside a layered system of institutions, policies, networks, and mechanisms that determine how money is created, moved, and valued. While people experience money as personal freedom, that experience exists within boundaries shaped by central banks, commercial banks, digital infrastructure, and regulatory systems. Understanding this does not remove participation from the system. It changes how that participation is seen. Money becomes less about absolute control and more about navigation within a structured environment. And in that understanding lies the difference between simply using money and truly understanding the system that defines its behavior.